Following on from the first episode where I covered the basics of market noise, this time I begin to dig a little deeper into the fundamental question of why noise exists. Understand this and you'll be on your way to then being able to plan how to handle it in your own trading strategies. Stay tuned. Why does noise exist? What causes this seemingly random price action to occur? And is it even important to understand? Well, those of you that have watched some of my previous episodes know of my respect for Perry Kaufman and his massive contribution to the trading community. And no, I'm not on commission for this, but in his book Trading Systems and Methods, which is one of my favourite trading books, he covers an immensely broad range of subjects, but the concept of market noise gets mentioned up front in chapter 1. So clearly, Perry sees this as a major subject area that needs attention as a priority, and I fully agree with that. Noise is an ever-present phenomenon that we certainly can't get rid of, and so as traders we have to learn to work with it. In today's episode, I'll be providing you with an illustration of how I understand market noise personally, and this has always helped me with my own thinking behind the concept. So let's make a start. Last time we looked at how the analogy of a drunken man and the path that he would take home is analogous to the way that price action moves. But this time we're going to tackle the specific questions of what noise is and what causes it. So to do that, we first need to attempt to categorize price action. And I'm going to do a very simplistic version of this and categorize it into two. The first of these is what I'm going to call meaningful price movements. And you can think of these as the longer term directional and purposeful movements like that between A and B. And then the second category is the more random-like price behaviour, and this tends to be much shorter term and results in more erratic movements, and for this we can see the red line. And the very basic reason for this is that it's a result of the huge number of market participants that are simultaneously buying and selling an asset, as a whole multitude of different strategies are executed by those traders in line with their own objectives. Now, all of this will be happening across multiple timeframes. So for example, we'll have buying and selling activity from high frequency trading. We'll have new scalpers, all the way up to carry trades that might go on for significant periods of time. There will be buy and hold investors that are causing transactions to be executed. And then there'll be day traders who are in and out of their positions within the space of a day. And all of these different time frames will be occurring simultaneously. But not just that, there'll be an extremely wide range of strategies being executed against an asset. So you'll have trend followers, and these trend followers themselves will be executing across multiple different time frames, just like those mean reversion traders will. There'll be breakout strategies causing buying and selling action, pairs trading and arbitrage trading. And as well as traders trying to exploit the markets, there'll also be long-term investing going on. So pension companies will be investing pension pots into various different assets in the market. And then if one isn't performing well, they might withdraw from that. And again, we've got all of this buying and selling action going on simultaneously. Now, the effect of this is that in the short term, we see a seemingly random noise in the price action. Now, the reason that it's random, and I'll explain this in a bit more detail in a moment, is based on which transactions happen to be driving the price during that particular bar and in which order they're being executed. And the point here is that this occurs even when there is a prevailing sentiment that might be sending the price action in a specific direction with more meaning. So let's take a look at this simple illustration that I told you about earlier on, which is how I personally understand these random price movements and compare those with the purposeful price moves. And to do that, I break this down into a number of buying and selling scenarios. And so at a specific moment in time, let's say that there's some fairly significant buying pressure because a pension manager is investing in a particular asset. And this buying pressure causes the price to move upwards. But then moments later, there might be a mean reversion opportunity in the market, and a short-term selling opportunity means that the price gets pushed down slightly. This might produce an opportunity in a longer time frame for trend followers, and this produces buying pressure. Now, obviously here I'm only considering a few individual transactions. The reality is that there will be tens of thousands of these executing every minute, and the order in which they're coming in during that minute will seemingly be fairly random. But while all of these are taking place, remember, there's likely to be some underlying sentiment that is driving the price action in a particular direction. So although we see upwards and downward movements caused by these seemingly random actions in the market, we still have this underlying direction behind all of these moves. And so it's this overall longer term sentiment, which is bullish in this particular case, that's driving the meaningful price movement from the bottom to the top here. But each of these individual transactions we see on the left could easily have executed in a different order. And if they did, this is what we might have seen. And if we compare this to what we had initially, which was this, there's a key takeaway here. The first is that all of those transactions were going to take place, and so the net movement here is the same for both of them, because this is the meaningful move, and this is in line with that longer term bias that's dictating the direction. But the individual price moves that combine together to give us that meaningful action are in a different order, just because certain traders executed their trades in a different order. And that is why these shorter term moves are more random in nature than the larger moves. And I've always found this illustration helpful in terms of helping me to distinguish between what is noise and what is a meaningful price move. Now, moving on from here, in the next episode, I'm going to start looking at how noise specifically affects trading systems in an adverse way. And I'm going to concentrate in this episode on trend following strategies. Now, if that episode is already available, then you can find it top right now, but that's all we've got time for in this episode. And so now, until next time, trade wise, trade safe.